Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss 3 high quality companies that are currently considered undervalued at their current stock price. All 3 of these companies are currently trading below their estimated fair value per share according to Morningstar, and they're all trading at a discount anywhere between 10 and 15% of that estimated fair value from the latest Morningstar reports. So overall, these are 3 high quality businesses. They all operate in different segments of the market. They have growing revenue and profits each year that are definitely worth doing some research into for your own portfolio. So in this episode, we're going to do a quick overview of each company, go over their current valuation, some recent financial performance, and discuss the dividend payments from each of these businesses as well. So overall, this is just going to be a quick overview to give you some ideas of businesses you may be allowed to buy for your own portfolio that are currently undervalued and you can pick up at a nice discount. But before we jump into stock number 1, I just want to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and on this channel we talk about the stock market, go over any major market headlines, and of course we track the progress of my own portfolio that currently sits at $188,000. And if you check out my most recent video, I did a full overview of this portfolio, went through each and every holding, and discussed my investment plan going forward for the remainder of 2023. But now in this episode, let's move right on into the first stock we're going to discuss, and that is ticker BLK for BlackRock, one of the world's leading asset management firms, currently trades for $695 per share. And right away, if you take a look at this high price point per share, just remember most brokerages out there do offer fractional trading. So if you can't muster up $700 in order to purchase one full share of BlackRock, if you do your own research and want to actually purchase this business, just be aware you can put in whatever sum of money you want and buy a fractional share of this company. So you can also see over the past 12 months, they are pretty much flat, only down 0.19%. They have a market cap just above $103 billion, are trading with a forward PE ratio of 19.3, and a pretty nice dividend yield right around 2.9%. And of course, with these strong companies, getting a yield above 2.5% with a dividend that actually grows pretty consistently at a double-digit rate year after year is very enticing for investors. And we can see back in 2022, this company surpassed over $10 trillion in assets under management. That's just absolutely unheard of. $10 trillion in assets under management for BlackRock, and this number continues to grow over time. They make accretive acquisitions, the business purchases more assets, and more funds actually get deposited in their different ETFs on the market, which continue to bring up this number. And of course, as you know, BlackRock will continue to take a small fee each and every year for managing this massive portfolio. And if we jump over to the Morningstar report, this is a simple report that Morningstar publishes for each company that shows the latest close as well as their estimated fair value for that business. So we can see the estimated fair value per share is at $775, and with the stock currently trading right around $695, that represents a 10 to 11% discount from the true fair value right now. So of course, Morningstar is a rating agency. They do their discounted cash flow and their various analysis to come up with this $775 fair value. But in comparison to other rating agencies on the market, Morningstar always seems to be somewhat more of a conservative basis. So $775 could be considered a conservative estimate for that fair value right now. And if we take a look, this is a business that continues to expand. Overall total revenue back in 2018 was at $14.2 billion, and that continued to grow year after year with only a slight pullback in 2022. And my personal prediction is that BlackRock will continue to expand their core operations, the total revenue number will continue to climb and surpass the previous high of $19.3 billion in only a few years. And if we take a look at the company's profitability, they do have some very nice gross margins. As well, if we take a look at the bottom line, they do remain consistently profitable, growing profits over the long term with over $5 billion of profits during the last 2 fiscal years. So this is a nice, growing, profitable business that may be worth taking a look at, and that is trading right around a 10 to 11% discount from the Morningstar estimated fair value. And if we take a look at their dividend, with the current yield at 2.9%, they pay out $20 per share with a payout ratio right around 55% of their net income. So that's a very manageable payout ratio. It gives the company enough profits to reinvest back into their business, but also gives them room to grow that dividend going forward. And over the past 5 years, they have a CAGR right around 12%. So that dividend income is growing at a nice high rate each and every year. And if we jump over to one of their latest investor presentations, we can see that since 2003, this company has grown their dividend at a CAGR at 17%. So overall, massive consistent dividend growth year after year. So we can see back in 2003, they paid out 80 cents per share per year. That number has continued to expand rapidly to $20 per share per year at this current point in time. And overall, this company continues to buy back more and more shares from the outstanding market as time goes on as well. So not only are you getting a growing dividend and cash flow into your portfolio, your actual ownership into this business is growing as well, because back in 2012, they had 171 million shares outstanding, and that number has now climbed down to only 150 million, a reduction of 13% during the past decade, a compounded annual return of right around 15%. And we can see over the past decade, this company has actually outperformed the greater market. Represented in orange, BlackRock grew 319% from 2012 through the first quarter of 2023. And in comparison to the S&P 500, that grew only 251%. So BlackRock does have a history of outperforming the overall market as well. So overall, this is the first high quality company that we're going to discuss in this episode that is trading below the estimated fair value. If you need some further exposure to the financial industry and you don't want to own a traditional bank, BlackRock is definitely a company worth doing some research into, and it may make a nice fit into your portfolio, especially at the 10 to 11% discount that it currently trades at right now. So now we're going to continue on and move straight into the second stock for this episode, and that is ticker NKE for Nike. They currently trade right around $97 per share, and over the past 12 months, the stock is down 14%. But if we actually take a closer look on the year-to-date chart, from a peak in early 2023, the stock price is now down around 25%. So over the past 6 months, the share price has fallen by 25%, which is a major decline for the consumer giant. And due to the drawdown in share price, Nike is now trading below their estimated fair value, which is set at $110 per share. So with the company currently trading right around $97, that's an 11% discount from their estimated fair value. So overall, you can purchase one of the largest consumer brands on the planet at a 10 to 11% discount, trading at their current level. And if we take a look at this report, the Nike brand alone is the most valuable apparel brand on the planet, representing a value of over 30 billion US dollars. So the Nike brand alone is already a massive company on its own. And as well, Nike has a 38.23% market share in their respective industry. So this is a market leader in the consumer apparel company. We all own Nike products. I believe we will continue to own Nike products for many years down the road. And just due to their massive distribution network, their massive scale, I really don't see any new consumer company on the market even take a significant portion of this 38% away from Nike anytime soon. And I think this business will continue to grow, sell more volume of products, increase prices over the long term, and just generate growing revenue and income for many years down the road. And if we take a look at their current valuation, they're trading with a forward PE ratio of 26.3, a dividend yield at around 1.4%, and they have a market cap right around $149 billion. And now if we take a quick look at the company's financials, year after year, this company continues to grow total revenue like clockwork. Back in 2019, they had $39 billion of total revenue. That continues to expand year after year to over $51.2 billion of total sales during the last fiscal year. The company generated gross profits above $22 billion. And if we take a look at their net income overall, they generate over $5 billion of profits during the past year as well. Their net income numbers do fluctuate over time because of different acquisitions or different divestitures, but this business is profitable, and I do believe will continue to generate growing profits for many years down the road. And if we take a look at the balance sheet of the business, they have over $10.6 billion of cash, so a lot of cash on the balance sheet, which I do love as an investor. Their total current assets are above $25 billion, with current short-term debt at only $9.2 billion. So their cash pile alone of above $10 billion can handle all their short-term obligations. So at this current point in time, they do have a very strong short-term balance sheet. And if we take a look at their debt level, since 2020, no significant increases, the total debt has actually declined by $500 million. So overall, the company made a couple acquisitions back in 2019 into 2020. So the company did issue debt in order to fund these acquisitions. But overall, we can see since that price point, nothing much has changed. And overall, it continues to decline over the long term. So this balance sheet I am happy with. And overall total equity has increased over time, which is another strong sign. And if we take a look at their current dividend, the yield at 1.4%, of course, is nothing great. You do own Nike for the long-term share price appreciation, but the dividend income every quarter is nice as well. It only takes up 41% of their total net income, which is very manageable, and that's a very safe and consistent payout ratio with a 5-year dividend CAGR at 11.2%. So your dividend income is actually compounding at a decent rate as well year after year. So along with the growing dividend, Nike also returns a ton of capital to their shareholders in the form of stock buybacks. And we can see since back in 2009, year after year, the company has continued to buy back their shares, doing a significant reduction in their outstanding share count from around 1.97 billion back in 2009 to only 1.57 billion in 2023. So year after year, quarter after quarter, the company continues to buy back their own stock, returning more and more capital to Nike shareholders. So overall, Nike, one of the world's largest consumer brands, one of the most recognizable brands on the planet, has seen a significant pullback in 2023. Like we saw during the past 6 months, the share price has now fallen 25%. I think Nike as a whole will be a business that will be around and generate profits for many years going forward. This is a company I do not own in my personal portfolio just yet, but I am highly considering starting a position at around this $96, $97 price point for my current portfolio as well. So definitely a company worth taking a look at, and that is stock number 2 for the companies we're going to go over in this episode. And now we're going to continue on into the third and final stock we're going to discuss in this episode. This company is not as well known as a BlackRock or a Nike, and they really don't get that much attention in the media. The stock we're going to take a look at is ticker TRU for TransUnion. The company currently trades for right around $80 per share, and this is one of the leading credit bureaus within the United States. Over the past 12 months, the share price is up only 3.26%, so not a huge gain during the past year. They are trading with a forward PE right around 22.2, with a minimal dividend forward yield at 0.53%, and a current market cap just above $15 billion. So of course, in relation to BlackRock and Nike, which are some mega cap companies with market caps above $100 billion, they are smaller in relation. If we take a look at the company's description, like I mentioned, they are one of the leading credit bureaus within the United States. They provide the consumer information that is the basis for granting credit. So if you're out there looking for a car loan or a new credit card, TransUnion may be the company providing that information to the lender. As well, the company provides different fraud detection services, marketing and analytics services. And one thing I like about this business is they do not generate their revenue solely from within the United States. Around 1/4 or 25% of their revenue comes from international markets. And if we take a look at one of the latest investor presentations, we can see they have over 600 active solutions, over 500 million credit histories, and we can see their footprint is pretty much in every continent all around the world. They are one of 2 players in Canada. They have over 230 million consumer reports within the United States. They hold the number 1 or number 2 position in Latin America and also have some footprint in Africa and Europe as well. So this company is very well spread out across international markets. It is not solely reliant on one nation for all of their revenue. And if we take a look at the Morningstar report, the estimated fair value comes in at right around $90 per share. So with the company currently trading just around 80, that represents a 12% discount from the estimated fair value. So overall, this is definitely another company worth taking a look at for your portfolio. Not many investors have a credit bureau or have any investment into this type of industry. This is a growing business that continues to expand their core operation through market expansion as well as different accretive acquisitions. And if we take a look at the company's financials, year over year, they generate growing revenue. 2.3 billion back in 2018 has now grown each and every year to over 3.7 billion in the trailing 12 months. They are profitable with very high gross margins. And if we take a look at the net bottom line, this company has been profitable over the past 5 years. Net income does continue to fluctuate based on their different business operations. You can see a major spike in 2021. This is because the company did sell a portion of their business, but they also made a major acquisition in 2021 as well. So overall, we can see a nice $1 billion kind of markup in earnings for that year from discontinued operations. This was a one-time event, but also within that year, the company did issue a lot of debt in order to make a $3.1 billion acquisition, we will see by jumping over to the balance sheet. So if we take a look at their current position, they have $1.4 billion of total current assets, with current debt being $935 million. So overall, the company is in a very solid position regarding their current ratio, right around 1.4 to 1.5. If we take a look at the long-term debt, we can see the major balloon up in 2021, where it went from $3.4 billion up to $6.3 billion. So of course, when you see a major growth in debt, you want to kind of understand what happened during that year. And in 2021, the company acquired Morningstar for $3.1 billion. So of course, this was an accretive acquisition. This was used to combine Morningstar's kind of area of expertise and combine it with TransUnion's product to create an all-in-one service that helps with identity crises and actually identity theft prevention in order to help the individual track their identity and keep it private. So this kind of acquisition was a key part in building out TransUnion's core business. So I am a fan of this acquisition, and that kind of explains why the debt level has increased significantly back in 2021. And we can see from that point, no major long-term debt has been issued. It's actually been getting reduced each year, every single quarter, and that's what we want to see. So overall, the company does have a decently high long-term debt level right now. I do think the debt is manageable. I'm not concerned about this long-term debt, and the company is not issuing debt in order to just grow operations or maintain stability. They're using it to build out their product mix by acquiring accretive companies that will overall provide a great benefit to the shareholder over the long term. And if we do take a look at that dividend, this dividend is new. It's only been paying out for the past 2 or 3 years. Their current yield is at 0.53%. Their payout ratio is very small, only at 12% of their net income. And I like companies who are still in that growth stage. I'd rather them either not pay a dividend at all and reinvest all the capital back into the business, whether that's acquiring more companies, expanding into new markets, paying down debt. I like companies who kind of prioritize internal financial health when they're very new and kind of very early on. But overall, this company decided to pay out a dividend, and I like how they kept it small. 0.5% yield. They only pay out 42 cents per share per quarter, and they only are paying out 12% of their net income. So overall, not too concerned with that. And over the past 2 years, the company has grown that dividend at a rate of 22%. So overall, this company is very small in terms of dividend. You're not purchasing this business for that current income. This is a player that you want long-term exposure to the credit bureau industry. And overall, they're one of a few companies that is winning in that market right now. And they are trading below their estimated fair value. So definitely worth taking a look at. So overall, if you've stayed all the way to the end, I want to thank you for watching the video. Of course, in this episode, we went through BlackRock, Nike, and TransUnion. 3 high quality companies, definitely worth doing some research into for your own portfolio. These are companies who are currently trading below Morningstar's estimate of their true fair value and may be worth buying at a nice discount right now. So definitely do some research into them. Leave a comment down below, like the video, and I really appreciate you tuning in all the way to the end. I will see you in the next video.